about a macro event like interest rate changes or a peace treaty. This was purely a market structural move. The positions were too heavy on the long side, and the boat capsized. Everyone fell out, but now the boat is righting itself. This violent shakeout is actually a bullish signal for January. Had we gone straight to $100 without a correction, the crash would have been far more devastating. The market would have been overextended and vulnerable. But by correcting now, we've flushed out the leverage. The excess risk has been cleansed. We've reset the open interest and cleared the decks for fresh money to enter in January. The institutional capital we've talked about, the pension funds, the big players, they're waiting for the perfect entry point. And now, at $78, the stage is set for them to step in. The next key area to focus on is the gold market. Gold, priced at 4,514, has barely budged. This lack of volatility in gold, despite silver's wild swings, is a powerful signal. Gold remains the anchor. As silver gyrates, gold remains calm at all-time highs. Why is this important? Because it confirms that the underlying monetary system is still fractured. The instability in the paper markets may have sent silver's price flying in all directions, but gold's steadiness suggests that the broader economic conditions haven't shifted. Gold is holding strong above $4,500, signaling that the floor for silver is still intact. And even as silver faces this volatility, it's behaving like the high beta asset it is. Silver will continue to surge harder than gold in the long run. This wild behavior, while exhausting, is exactly what silver bulls have been waiting for. The risk has always been there, just a much higher potential reward if you can stomach the swings. Let's take a moment to reflect on the current market dynamics. The pullback we saw from $83 wasn't just a flash in the pan. It's part of the broader cycle that helps reveal silver's true potential. This flash to $83 was the market's way of testing the ceiling. It showed us that silver has the energy to rise to those heights, even momentarily. But the truth is, we're not done yet. This flash rally served as a preview. It revealed the true upside of silver's potential. And what's even more important, it set a new benchmark for silver's price in 2026. We've already seen silver hit $83. The next time it tests that level, the sellers will be gone. The weak hands have already been shaken out. The strong hands remain, ready to ride the price to new heights. The trajectory is clear. If you're holding, you're in a position to benefit when silver breaks through the $83 barrier again. And when it does, the next target is likely to be $100. That's when the real excitement begins. Another critical factor to watch is the gold to silver ratio. As silver flashes up to $83, the ratio briefly dips into the 50s before recovering to the 60s. As of now, with silver sitting at $78, the ratio is hovering around 57. The trend is still clear. Silver is outperforming gold. Even during this volatile pullback, silver is showing relative strength compared to where it stood just a week ago. Last week, $65 was a massive win. Today, at $78, we're seeing relative disappointment because the market expected more. But that's just human nature playing tricks on our minds. When we see price moving up, we start thinking in terms of bigger, quicker profits. But even at $78, we've come a long way from $65. We're still up, just not as much as we thought we'd be. This is progress. This is wealth being created. Moving on to the topic of stop losses, let's revisit one of the most painful lessons learned in today's crash. Many traders, particularly those using leverage, got taken out at the bottom. If you had a stop loss set at $74, you got wiped out when the price fell to $74.47 and then quickly bounced. That pain is real. But the lesson here is simple. Stop losses are dangerous in a market like this, especially during volatile periods like Ghost Week. The low liquidity creates an environment ripe for market manipulation. With the volume thin, the price can whip around wildly, triggering stop losses left and right. If you had a stop at $74, you sold the bottom, and now you're watching silver trade $4 higher. That's the volatility tax. And the only way to avoid it, remove your stop loss orders. Instead, trade small enough that you don't need them. Or better yet, hold physical silver where stop losses simply don't apply. If you hold the physical metal, you don't have to worry about being shaken out by market volatility. Now let's talk about the future. We're heading into 2026, and the setup for silver is as bullish as ever. The volatility we saw today, while brutal, has flushed out the over-leveraged traders. The weak hands are gone. This means that when the big money arrives in January, the market will be ready. The groundwork has been laid for silver to continue its climb higher. The heavy institutional money, the pension funds, the hedge funds, they'll be entering the market with fresh capital, ready to buy. They'll see $78 as a bargain compared to the $83 flash. And as the silver market clears out the excess leverage, we're left with a solid foundation for the next leg up. It's a staircase pattern. The floor is rising, and with it the potential for higher silver prices. So, as we enter the new year, don't let the short-term volatility distract you. The long-term trend is undeniable. One last point of focus, the December monthly close. We're just a few days away from the end of the year, and the monthly candle is about to close. If silver finishes the month above $75, it will mark the highest monthly close in history. This is huge. It signals to the long-term trend followers that the bear market is over. It tells us that a new secular bull market is beginning. Secular bull markets last for years, not just a few months. The candle on the monthly chart will print a massive green signal, validating the long-term bullish trend. Even with the volatility of today, even with the flash crash, the bullish trajectory is intact. And that's the most important takeaway. If you've held strong through the volatility, you're well positioned for the next stage of this bull market. So hold your ground, stay calm. The end of 2025 is shaping up to be a pivotal moment, and you're ready for what comes next. Let's wrap up. If you've made it this far, you've already survived the worst of the volatility. You've held steady as the rug pull tried to shake you out of your position, but you stayed strong. And now you're ready for the next phase of this rally. The banks have done their dirty work. The weak hands have been forced out. Now we enter the quiet before the storm. The institutional money is coming, and when it arrives, the trajectory for silver is clear, upwards. Expect bumps along the way, but the long-term trend is unstoppable. So, stay safe, stay calm, and get ready for 2026. The market is about to take off. You've positioned yourself in the only asset class that offers true protection from inflation and exposure to the new energy economy. The hard work is done. Let the bull market do the rest. As we look ahead to January, the key takeaway is that the market has reset itself. The leverage that was accumulated during the excitement of the $83 flash has now been wiped clean. What remains is a market ready for the institutional money that will start flowing in the new year. This is exactly what we've been waiting for, the clearing of the decks. It's a perfect storm for silver bulls. Once the institutions step in, they won't be looking for the quick buck that the speculators were chasing. They'll be looking for long-term solid value. And silver, with its volatile behavior and potential for massive gains, is exactly the kind of asset that fits their profile. The big players don't panic when prices swing wildly. They know this is a normal part of the process. They're waiting for the entry point where they can safely place their bets. And right now, that price is looking like a bargain at $78. The $83 flash will look like a distant memory in a matter of months as the true value of silver becomes undeniable. The risk of being left behind in this market is real. As the volatility calms and institutional buyers enter, the price of silver will begin its climb again, possibly breaking through $83 and heading toward the $100 mark. We've seen this play out before. History has shown that once the institutional money floods in, it's nearly impossible for retail investors to catch up unless they act fast. The window of opportunity is still open, but it's narrowing quickly, so the message is clear. If you're still holding physical, you've already made the right move. If you're holding paper contracts or futures, tread carefully. This market is volatile, and if you're not properly positioned, it can be devastating. But for those who are positioned well, who have weathered the storms of volatility, the upcoming months are looking like nothing short of a bull market on steroids. Get ready, because the real money is about to pour in, and the silver market is about to get very exciting. Brace yourself as we dive into the chart that's currently flashing before your eyes. Don't focus on the price. Look at the line, that towering vertical spike shooting up from the candle. It's not just a line, it's a crime scene. Silver's price briefly surged to $83.71. This wasn't a gradual climb, it was a sudden teleportation. 1 minute, it sat around $79, and the next, it shot straight to $83. And just as abruptly, it collapsed. From $83.71, it plummeted down to $74.47. That's a staggering $9 swing in a single session. If you're a newcomer to investing, you're likely shaking in fear. You're thinking the rally has already ended, the bubble has popped, and the party's over. But if you're a seasoned veteran, if you survived the chaos of 1980 and 2011, you know exactly what this is. This was no accident. This was a calculated, algorithmic stop hunt. A ruthless attack designed to wipe out the leverage traders who eagerly chased the gap that opened on Sunday night. The big players saw liquidity drying up during Ghost Week. They watched as the order book emptied. So they let the price run up to $83, drawing in the retail traders, the FOMO crowd, and as soon as the trap was full, they slammed the door shut. Let's dissect this brutal $9 swing in today's market analysis. We'll examine the shooting star candle forming on the daily chart, explaining why this volatility, no matter how heart-stopping, is ultimately healthy for the long-term trend. And most importantly, we'll reveal why the physical price of silver did not drop by $9 today. The paper market is whipping around like a flag in the wind. But the flagpole, that's unshakable. This is the Monday rug pull. To understand why silver dropped from $83, we need to look at who was buying at $83. It wasn't the smart money. The smart money was buying at $30. They were buying at $50. The ones buying at $83 on a Sunday night gap open were the chasers, the FOMO crowd, the ones using 10 times leverage, hoping to get rich quick. The banks have access to a database. They know exactly where these traders have placed their stop-loss orders. A stop-loss is an automatic sell order that triggers when the price drops to a certain level. The majority of people who bought at $80 set their stop-loss at $75. The banks saw this coming. They engineered the drop. They sold a massive block of futures at the high point. This triggered a downward spiral, taking the price from $79 to $78 and eventually to $75. And when the price hit that $75 level, it triggered an avalanche of sell orders. Thousands of retail traders were forced to liquidate, cascading the price down to $74.47, all because of forced liquidations. And who was waiting at $74? You guessed it. The same banks that sold it at $83. They sold high, forced you to sell low, and then bought back your positions at a massive discount. This is known as rinsing the leverage. It's brutal, it's unfair, but it's how the market forces out the gamblers before the next wave of upward movement. Now let's analyze the chart pattern. This candle is what traders call a shooting star, or a high wave candle. It has a small body with a long upper wick. That wick, it represents rejection. It shows that the market tried to push to $83, but the sellers were able to push it right back down. Usually, a shooting star signals a pause, meaning that the buyers are exhausted. They ran out of steam, and now the market is likely to consolidate. Don't expect another straight shot upwards. We could chop between $75 and $80 for a few days as the market digests this $9 swing. But here's the most important piece of data to focus on. Despite the flash crash from the highs, look at where we closed. We closed Friday at $71.91. Right now we're trading around $78.36. That's almost a 10% gain from last week. Ignoring the wick, ignoring the flash to $83, this is still a massive green day. The long-term trend is still intact. The breakout is still valid. The only thing that has changed, the easy money phase is over. Now, we enter the volatile grind. Let's talk about gold. Gold is currently trading at $45 at $14. It's down slightly, about $4. But this represents stability. While silver is whipping around wildly, gold is calmly sitting at all-time highs. What does that tell us? It tells us that the monetary system is still broken. Gold is the anchor. As long as gold holds $4,500, the floor under silver remains solid. Silver is just acting like the high beta sibling. It overshoots to the upside and the downside. This volatility is the price you pay for silver's potential. If you panicked when the price dropped to $74, then you were probably over-leveraged. The physical silver holders didn't panic. They looked at the drop, shrugged, and went back to eating leftovers, because they know 1 ounce of silver is still 1 ounce. Now let's talk about Ghost Week. We warned you that low volume creates air pockets. Today's price drop was the proof. The reason silver could plummet $9 so easily was because the order book was empty. There were no buyers in the middle. The price fell straight through the gap until it hit the limit of industrial buyers waiting at $75. Notice where it bounced, right at $74.47. Why there? Because $75 was the breakout level from last week. Old resistance becomes new support. This market tested that breakout, and it held. This is textbook behavior. The market tested the $75 floor, and the industrial whales stepped in, buying the dip aggressively and pushing the price back up to $78. This confirms that the industrial bid is real. Samsung and Tesla weren't the ones chasing silver to $83. They're too smart for that. They waited, let the banks do their dirty work. Then they bought up the contracts at $74. Smart money buys weakness. Dumb money buys strength. What we saw today was a wealth transfer from the chasers to the smart money. We need to look deeper into the physical market reaction. When the price of silver dropped to $74, did dealers lower their prices? Did they start selling silver cheaper? No. They kept their prices steady. In some cases, they even raised premiums. This is the most crucial signal for the physical investor. The spot price crashed, but the street price held firm. Why? Because dealers know the volatility in the paper market is fake. They know if they sell a silver eagle at $78 and the price bounces back to $83 in an hour, they lose money. So they're not willing to gamble with their physical inventory. They view the physical metal as a stable store of value, while the paper market is nothing more than a broken casino. So if you were waiting for the dip to buy physical silver, chances are you missed it. The window to buy at $74 was only open for about 15 minutes. And even then, websites were probably crashing or showing out-of-stock signs. This proves that the dip was a paper event, not a physical one. There was no panic selling in the physical market. No one was rushing to dump their silver bars. It was all a computer algorithm unloading futures contracts. Let's look at the industrial reaction. Imagine you're the procurement manager for a solar company and you need silver. You've got a budget and you're watching the price hit $83. Did you panic? No. You saw that drop to $74 as a gift. You bought it. You hit the buy button on your hedging software immediately. This $9 drop was an opportunity for industrial buyers to secure inventory at a discount before the end of the year. The banks may have tried to smash the price to clear out the speculators, but they inadvertently gave the industrial buyers a discount, and that's why the price bounced so quickly from $74 back to $78. The industrial buyers came in and absorbed the selling, converting it into physical delivery requests. This forms a higher low. Last week, the floor was $65. This week, it's $74. The steps are getting higher. The direction is still the same, up. Next, let's address the volatility tax. Volatility is a tax on leverage. If you were trading futures or options or margin today, then you got wiped out. You paid the volatility tax. But if you hold physical, you paid nothing. Your ounce of silver is still an ounce. In fact, you gained valuable information. You now know that the market is capable of hitting $83. That flash to $83 was a glimpse of the future. It showed us where the price wants to go when the suppression lifts, even for just a moment. Think of it like holding a beach ball underwater. For a second, the grip slipped and the ball shot up to $83. The banks wrestled it back down to $78. But now we know how much energy is stored in that ball. We know $83 is not the ceiling, it's just the first stop. We also need to look at the currency crosses. Silver didn't just crash against the dollar, it crashed against everything, yet it quickly recovered against everything. The dollar index is relatively flat. This tells us that the move was specific to silver. It wasn't